Okay, so it's going to be one of these technology nights. Okay, let's try this again. Okay, I already have them up there anyway. Seriously? All right. Seriously? Okay, I don't know what's going on here, but I know how to fix it. Okay, can you see the slide? No.
No.
All right. Seriously, I'm playing the recording now? What is wrong with me tonight? Okay. I'll go back to pulling it up again. Okay, I'm beginning to think it's my computer. I'm sorry, you guys. I don't know what's going on. Wow. Oh, you know what I'm going to do? I'm going to pull it up from here. I'll take it. Perfect. Okay, quiz review. All right, so question 1. We're looking at so on July 1st, a company paid the $6,000 premium on a 1-year insurance policy with benefits beginning on that date. what will the insurance expense on the annual income statement for the first year ended December 31st be? So the first thing you want to do is you want to look at this and you want to say, okay, what is it I'm trying to find? You're trying to find what? What are you looking for?
Annual income statement?
The expense, exactly. You're looking for the expense. So we're trying to find out how much the insurance expense is. So what do we know?
$6,000 prepaid or paid for the year.
We know $6,000 was prepaid for the whole year, right? So if we prepaid $6,000 for the year, when did we do it? It's really important to pay attention to dates on all of the adjusting entries, because dates are what will trip you up easily.
July 1st.
So July 1st. So if we paid $6,000 for a 1-year premium, we know that that $6,000 divided by, it's for 12 months, right?
Yes.
So how much per month? 500.
Yeah.
So $500 a month is our insurance expense. All right, we did this on July 1st. We haven't done any journal entries, and we're going to record this as of December 31st. So the first thing you have to do is figure out how many months. So July, August, September, October, November, December. 6 months, right?
Yes.
So all you have to do now is how much is the insurance expense for 6 months? We're going to take our $500 a month times 6 months, so $3,000. So the things you have to look for is, the first thing to look at is, what are you being asked? You're being asked for the expense. So how do you figure out the expense? Do you have to do a journal entry here?
Yeah.
No. All it says is, what's the annual insurance expense? So the insurance expense is $3,000. The answer on your test would be whatever the number is, but in this case, it would be $3,000. My insurance expense was $3,000.
Oh,
If you were going to, right, if you were going to do the journal entry, then you would be recording insurance expense and reducing your prepaid insurance for the $3,000. So then on the income statement, you're going to have your insurance expense, and on the balance sheet, you're going to have, you started out with prepaid insurance of $6,000. You've used up $3,000. So you're going to have on your balance sheet a balance of $3,000. Are we good there?
Yes.
Okay, question 2. Now we have a 2-year insurance policy that was purchased on June 1st. And we want to know, again, insurance expense that would appear on the income statement at December 31st. So June 1st, how many months are we going to record this time?
7.
Yep, 6/1 through 12/31 is 7 months. So we have $154,800 over how many months?
24.
24 months. How much is that per month?
6,450.
So how do I figure out my expense?
Yeah, multiplied by 7.
Yep. Any chance you did that?
45,150.
45,150?
Yes.
Still trying to get into my calculator. Is your insurance expense for the 6 months, 7 months. All right, are you good here?
Yes.
See, now those first 2 problems, you already got them. Question number 3. Here we want to know, we're going to want to know the adjusting entry. So now not just the expense, the whole entry. Fragmental company leased a portion of its store to another company for 8 months, beginning October 1st, at a monthly rate of $2,200. Fragmental collected the entire $17,600 cash on October 1st and recorded as unearned revenue. So we have to think about, what did we do when we collected that cash? When on October 1st, we would have recorded cash and unearned revenue. For $17,600. So right now, when we start here, our unearned revenue account starts out with a credit balance of $17,600. That's what happened before. Now we want to record the journal entry for the rent income for October 1st through the end of the year. So how many months is that?
3.
Yeah, 10/1 through 12/31 is 3 months. So we have $2,200 a month times 3 months is $6,600. Is that right?
Yes.
Yeah. And that's my rent. Be careful, it's revenue. We've leased part of our space to somebody else, so that's actually revenue. So I'm going to reduce this by $6,600. And my journal entry is going to be unearned revenue and rental revenue for $6,600. So this rental revenue is going to be on my income statement. On my balance sheet, I'm still going to have revenue that I haven't earned yet for the $17,600 minus the $6,600 that was earned. So I still have $11,000. That's going to be on the balance sheet. Are we good here?
Yes.
Okay. Question number 4. A company pays each of its 2 office employees each Friday at the rate of $200. We want to know the month-end adjusting entry to record the salaries earned but not paid. So a company pays each of its 2 office employees each Friday at the rate of $200 per day for a 5-day week that begins on Monday. So the week starts on Monday, we pay out on Friday. If the monthly accounting period ends on Wednesday and the employees work Monday, Tuesday, and Wednesday, how many days of salary expense have we not recorded?
2.
Monday, Tuesday, and Wednesday. Monday, Tuesday, and Wednesday. We pay on Friday. So if we need to record on Wednesday how much has been incurred that month but not recorded, how many days would it be? Let's go back to what happened. Okay, so what happened was, let's say that at the end of the month, your company, let's just say they paid you the last day of the month. Do they still owe you money?
Pay me for the whole month.
Yeah, they owe you money because there's usually a week or two that were kind of held back in the beginning, right?
Mm.
So you typically have another paycheck coming. So here, what we're trying to do is we're trying to make sure that all of the expense that was incurred in that month gets recorded in that month. But what happens with payroll is on Friday, when we make the payroll, when we cut the checks, on Friday, we're going to record the salaries expense for the whole week. The problem is that we need to record it with the journal entry on Wednesday for the period through Wednesday that hasn't been recorded. So the employees worked Monday, Tuesday, and Wednesday, and we haven't recorded it yet. Does that make sense?
That doesn't make sense to me. Why wouldn't it be
Okay.
for the Thursday and Friday, the 2 days that weren't
Well, because we will. We'll when we record the paychecks on Friday, we will pay them for all 5 days. But the problem is that we haven't recorded the expense, and we won't record it typically until Friday. But we have to make sure that it gets in this month, not the next month. So we're going to do an adjusting entry for it to make sure the expense goes in the right month. Does that make sense?
Makes sense now.
So this is 3 days worth of expense that we haven't recorded yet. At 2 of its office employees each Friday at the rate of $200 per day. At $200 a day equals $600. This is the salary expense that's been incurred, but we haven't recorded because we would typically do that on Friday when we do payroll. We need to do a journal entry for it now. So we're going to record salary expense and salary payable because we haven't paid it yet, right?
Mm-hmm.
For $600. Does that make more sense now?
Yes.
Yay! Here we're going to do entries, would be prepared to record. We're going to record salary again. The payment of salaries in January. Okay, an adjusting entry was made on December 31st to accrue, hold on. If you're not talking, would you please mute your mic?
Yeah, I have
Cody?
a question real quick on that last problem.
Okay.
So why would it not be 1,200 if it's 2 employees? Because aren't they each getting paid 200 per day?
Yeah, I forget which way it goes. I wasn't sure if they're each getting paid 200 per day or if it's 200 per day for both of them.
Okay.
But you'll be able to tell by the answers. You see what I'm saying?
Yes.
So that won't be confusing.
Okay. Thank you.
And everybody's numbers are different. All right, now to get payroll even a little bit more confusing, we have an adjusting entry that was made on December 31st to accrue salary expense of $4,000. So what we did before, what we did on 12/31, is we recorded salary expense and salaries payable. So that was all in the right period for $4,000. That's where we stand before. In January, we're going to do payroll, and the payroll is $7,000. What that means is that of this $7,000, $4,000 is from the prior month, and $3,000 is from this month. Does that piece make sense?
Yes.
Okay. So when we record this, think about what you know. You know that you have to remove salaries payable. So you're going to debit salaries payable. You know that you're going to pay out $7,000 in cash. And your salaries payable was $4,000. This other $3,000 is the salary expense. This is the salary expense for January. Does that make sense?
Is that also debited too?
Yeah, because it's
The
an
salary
expense.
Yes.
Mhm.
Okay.
Because do we increase an expense with a debit or a credit?
Ready?
No. What do? We increase an expense with a
Debit.
debit. So it's going to be a debit. Plus, the other reason you know it's a debit is because you have to have a debit to balance. And debits and credits always equal each other. Make sense?
Yes.
Gives you kind of two ways to think about it.
Yes.
Okay, depreciation. We want to know how much is depreciation expense. So a company purchased a new delivery van at a cost, I know I'm going to need that, of $60,000. The delivery van is estimated to have a useful life of 5 years. And a salvage value of $5,000. And I bought it on July 1st. So from July 1 to December 31, how many months is that?
6.
6. So I'm going to figure out the depreciation expense with the formula cost minus salvage value divided by life. So my cost is 60,000 minus my salvage value is 5,000 divided by, I'm going to need it in months. So I'm going to take 5 years and I'm going to convert it to 60 months because I know I'm going to need it in months. So if I take 55,000 divided by 60 months, I have $917 a month. The numbers on the test will work out perfectly because I just made these up. So I want to know how much expense is there for July 1st through December 31st. So what am I going to do?
Multiply by 6.
Yep, 917 a month times 6 months is 5502. That's my depreciation expense. Does that make sense?
Yes. The formula you got from the book, or you got it from?
It's from the book. It's also in the videos. For straight line depreciation, because this is straight line, which is all you've learned so far. We're going to do 2 more methods later. So it's cost minus salvage divided by the life. We'll work with straight line and 2 other methods again next week, or I think it's the week after that. I think it's in week 4. Okay, so far?
Yes.
What is the proper adjusting entry? So we know we're going to do an adjusting entry. At December 31st, the end of the accounting period, if the balance in the prepaid insurance account is $9,000 before, okay, so I know I'm going to need my account, prepaid insurance, would that normally have a debit or a credit balance? What type of account is prepaid insurance?
Asset.
An asset.
Asset.
So does it have a normal debit or credit balance?
It's a debit.
Debit.
It's a debit, yep. So we have $9,000 that we started with. And at the end of the year, the unexpired part is $4,000. That means the unused part, or the part we still have in the account, is $4,000. So how did I get from $9,000 to $4,000? What has to happen in my T account?
You have to debit 5,000. I mean,
Credit 5,000. That's what I have to do. What does this 5,000 represent?
The used insurance.
Yes, or we might call it insurance expense, right?
yes.
So the adjusting entry is going to be, we're going to record our expense, and I'm going to reduce my prepaid insurance for $5,000. You're going to see this on the income statement, and you're going to see this on the balance sheet. Are we good here?
Yes.
Adjusting entry. Wilson Company paid $8,000 for a 4-month insurance policy. And he paid it in advance on November 1st. So $8,000, 4 months on November 1st. So November 1st, 11/1 through 12/31, how many months is that?
1,
That's why I said you have to be really careful.
2.
2. The reason I know you have to be really careful, honestly, I used to have an 18-page final exam that I gave, and every couple of years I would rework everything from scratch. And there was this problem that every single time I reworked it, I would get it wrong like 3 times in a row. And then I'd realize I was missing a month. I hadn't counted the months correctly. So that's how I know you got to be really careful with the months. Paid $8,000 for a 4-month premium. So we have $8,000 for 4 months. So that's $2,000 a month, right?
Mm-hmm.
All right, paid it in advance. So when he paid it on 11/1, we have to think what happened before. When he paid it, he had prepaid insurance and he spent cash for $8,000. That was on November 1st. That's what happened before. So we have prepaid insurance, $8,000. That's where we stood on November 1st. The balance in the prepaid insurance account before any adjustment at the end of the year company paid $8,000 for a 4-month insurance premium in advance with coverage beginning on that date. The balance in the prepaid insurance account before any adjustment at the end of the year is $3,000 and no adjustments have been made. Oh, they must have had other insurance in there. So it actually doesn't matter. The balance in the prepaid insurance account before adjustment at the end of the year is $3,000.
It looks like he was charging an extra $1,000.
Yeah, there must be, I probably made a mistake when I was doing the numbers. I did this right after I got a concussion. So how do we get from 8,000 to 3,000?
I have to subtract 5.
Right, and we subtract it by crediting it. What is this 5,000 going to represent?
Insurance expense.
insurance expense. Are you noticing a trend here?
Yes.
So we're going to record the expense, and you should also be getting used to the fact that expenses are debits. We're going to reduce our prepaid insurance. I'm still having a problem with this. The balance in the prepaid insurance account before adjustment at the end of the year is $3,000 and no adjustments have been made. See, I still think this should be $4,000.
Yes, but it's like
Yeah, you know what? I'm actually going to go with, I'm going to change that number. I'm going to go with, I probably missed. So this should be, it doesn't matter. This shouldn't be there. $2,000 times 2 months is 4,000. So we'll do 4,000 and 4,000. I have to go back and look at that question. We want to know what amount should appear in the prepaid subscription account after adjustments. All right, so on April 1st, April 1st, 4/1 through 12/31, how many months is that?
8.
April, May, June, July, August, September, October, November, 9 months. It's 9 months, right?
Yes, the end.
Yeah,
9.
9 months. Santa Fe Inc. paid Griffith Publishing Company $4,500 for a 36-month subscription. So on April 1st, this is what was recorded. On April 1st, they got cash. Wait, who are we doing?
The prepaid first.
Other way around. We're the other company. Yeah. They had prepaid subscription. Santa Fe paid Griffith Publishing Company. What amount should appear in the prepaid subscription account? Prepaid subscriptions and spent cash for $4,500. So if we're looking at our T account, we have $4,500 in prepaid subscriptions. Now we know that it's $4,500 for 36 months. So how much is it per month? 125? Does that sound right?
Yes.
So we want to know what amount should appear in the prepaid subscription account. So what we want to know is, what is this amount? What's the balance? That's what they're asking for. That's our answer.
At the end of the year, right?
At the end, because it says what amount should appear in the prepaid subscription account after adjustments on December 31st. So we have 125 a month times 9 months. So how much is that? 1,125 was used. So this is going to go over here. Yeah, that's the expense. Right, this is going to be the expense, but we don't need to do a journal entry. So what's the balance in my account? If I started with 4,500 and I used 1,125, my balance is 3,000, yeah, 375. And that's the answer here. that make sense?
Yes.
So you have to
Yes.
watch the time periods, and you have to be very careful of what they're asking for. Like here, what is the adjusting entry for accruing interest? Okay, so we earn interest or incur interest expense all the time after we take out a loan, even if we don't pay it right away or receive it right away. So on December 1st, Milton Company borrowed $400,000 at 10% interest. Remember, the formula is principal times rate times time. And time is always expressed in a year. So if they borrowed $400,000 and the rate is 10%, and we're doing it for how many months?
1 year, so 12.
No, because we took it out on December 1st.
1 month.
1 month. So 1 out of 12 months. Because the interest is always expressed as a year. Times 0.10 equals divided by 12. All right, that's the amount, but we need the adjusting entry. So we're going to record interest expense and interest payable because we're not paying it right now, right?
Mm-hmm.
So it's a liability. We're going to pay it later. So it's going to be interest payable. And you know it can't be cash because if you're doing cash for an adjusting entry, you already know you're doing something wrong. Are you good here with interest?
So for the months, you'll put it, if it's less than a year, you'll put it under 12.
Mm-hmm.
Or if it's like 2 years, but you're not using the whole 2 years, it'll be under 24
If it was, okay, so if it was 2 years, it's still 10% a year. So if it was 2 years, you'd have to do 400,000 times 0.10 times 2 because it's 2 years.
But if it said like a year and 7 months or something, you put it, but for a time of 2 years.
Then if it was a year and 7 months, that's 12, that's 19 months. So you could do 19 over 12, or you could do 1 times 1 and 7/12.
Okay, all right.
Okay. I'm going to show you how to do this, but I'm going to give you credit for it. This is really the way the real world works. So we do what's called reversing entries. So what we do is Flag records adjusting entries at December 31st. At December 31st, employees had earned $18,000 of unpaid and unrecorded salaries. So at December 31st, we would record salary expense and salary payable to put the salary into the correct period. You always have a journal entry for salary at the end of every month. All right, so on 12/31, that's what we did so that this $18,000 ended up in the correct period. On January 3rd, we're going to pay payroll of $35,000. But we're going to use what's called a reversing entry. So what we do is, on 12/31, we make this entry. On January 1st, so now this is on the books for 12/31, right? On January 1st, we reverse it. And I'm going to show you why. So on January 1st, we just do another journal entry for salaries payable and salary expense And what you really do is put them both in at the same time with different dates. So when we've done this, what has happened is we have our salary expense account. Salary payable goes in and goes out, but our salary expense account has $18,000 in it, right?
Mhm.
At the end of the year. On January 1st, it doesn't have anything because we close it out. On the first day of the next month, when I do this reversing entry, I'm going to have a credit balance in my salary expense account. So if I looked at my salary expense account on the first of the month, it would look really weird because I have this $18,000 credit balance, which doesn't make sense at all, right? But the reason we do that is because now on January 3rd, we're going to pay this $35,000. When we do payroll, this way we don't have to think about, well, what part's for the January expense and what part was for the December expense and how much was the payable. I can just run payroll like I normally do in the computer, let it take care of it. And what's going to happen is when I do this $35,000, I'm going to record the salary expense like I normally would and reduce cash for the $35,000. And what happens is because I did that reversing entry, when I come over here, when I make that journal entry with payroll, now I've ended up debiting my salary expense $35,000. And what happens is my net expense ends up being the $35,000 minus the $18,000. My net expense ends up being $17,000, which is the January expense. And this $18,000 was the December expense. Do you want to talk about it? We're only doing it to make it easier.
So the reason you credited the 18,000 was to basically take it off from the 35,000 that you're gonna pay in payroll.
Yep, that's exactly why.
I understand. Just it looks like a lot, but
It does, but but it's actually faster. It looks like a lot when you're doing it manually, because if you really were doing it all manually, it wouldn't make any sense to do it. But since most of it's done on the computer, what happens is you have to do this 1231 entry because that otherwise there's no way to get the salary expense in December. So you do that entry and then you just immediately reverse it and then you're done. Now when you run the paychecks, they just run like normal, make the regular entry that the system makes, and you're done. So that's why it looks like it's a lot harder here, but in the real world, it's a lot faster. Prepare a closing entry for a list of accounts. Okay, remember, the first thing you do, so the purpose of closing entries, the entire purpose of closing entries is to mirror what is on what you did on the statement of retained earnings. You're taking all of your revenue and expenses and dividends and putting them into the retained earnings account. So remember, the first thing you're going to do is close revenue to retained earnings. Oh wait, if we use the income summary account, we're going to close revenue to income summary, which is an extremely temporary account. And the reason that you use income summary is, good heavens, I can't talk and write tonight. The reason you use income summary is because if I take income summary and I put my revenue, if I close revenue here, and then I close my expenses to my income summary account, Now my expenses are here. What does this balance represent? If this is my revenue minus my expenses, what is that balance? Where would I find a check figure for my income summary account? What is revenue minus expense?
Net income?
Yep. My check figure for this is my net income. That's why you would use the income summary account. The third thing you're going to do is you're going to close income summary to retained earnings. And then you're going to close dividends to retained earnings. And when I do this, expenses are 0, revenues are 0, dividends are 0, and everything's in retained earnings. Are we good here?
Yes.
Yes.
Okay, you have to be able to calculate the current ratio. So given a trial balance, calculate the current ratio. So to do that, you have to be able to do two things. One is you have to know the formula, which is current assets divided by current liabilities. Now, because you're given a trial balance, you also have to know what accounts are current assets. And what accounts are current liabilities. So you have to be able to identify those that are going to be used up in the next 12 months. So examples of current assets are cash, accounts receivable, short-term investments, and examples of short-term liabilities would be like accounts payable, a short-term note payable, not a long-term one, salary payable, taxes payable, anything that you look at that you're like, oh, we're going to pay that within the next year. And remember that the current assets will be listed before the non-current assets, and the current liabilities will be listed before the non-current liabilities. But given those numbers, you have to be able to identify current assets and current liabilities. Assuming no other changes, what is the balance of retained earnings? Okay. So at the beginning of the year, Sigma Company's balance sheet reported total assets of $350,000, total liabilities of $30,000, total paid-in capital of $100,000. During the year, the company reported total revenue. Okay, so I see how we have to do this. So we're going to say, all right, beginning retained earnings, total assets, no, total liabilities, total paid-in capital. So we need to find the beginning balance. So at the beginning of the year, we have assets equal liabilities plus owner's equity. And we have assets of $350,000. Oh, liabilities of $30,000. And paid-in capital of $100,000. So remember, there's two pieces. This is paid-in capital, but there's two pieces to owner's equity. There's retained earnings, and then there's like capital that the owners put directly in. So we've been given the paid-in capital portion, but not the retained earnings. So if I have $350,000 in assets, and I'm going to subtract my 30,000 in liabilities, and I'm going to subtract my 100,000 in paid in capital. That means that retained earnings must be 220,000. Do you see how we did that?
Mm-hmm.
So my beginning retained earnings is 220,000. Okay, now I know that to that retained earnings, I'm going to add revenue, subtract expenses, and subtract dividends. And I know that because my formula is beginning retained earnings plus net income minus dividends equals my ending retained earnings. So revenue and expenses are the same as net income. That piece makes sense?
Yes.
So we had revenue of 400,000. We had expenses of 300,000. And we had dividends of 80,000. So if I take 220,000 plus my revenue minus my expenses minus my dividends, my ending retained earnings balance is 240,000. Does that make sense?
Yes.
Yes.
Number 15, we want to do the closing entry for the revenue accounts. Okay, so if I'm looking at revenue, the retained earnings account has a credit balance of 60,000. Okay, so retained earnings right now has 60,000 in it before closing entries are made. Total revenues for the period are 70,000 and total expenses are 50,000 and dividends are 110,000. We only need to close the revenue accounts. Now, in the real world, we're not just going to close revenue in one lump sum. We're going to close every single individual revenue account, right? Otherwise, they won't be zero. But all we know here is that revenue for the period is 70,000. So is revenue normally a debit or a credit balance?
Debit?
No. We increase revenue with
Oh, yes. Correct.
a credit. So I have $70,000 as a credit. Now, let's talk about the journal entry to close it. What do I have to do if revenue is $70,000? What do I have to do to make it zero?
You have to credit 70,000.
Debit.
Yes, sorry.
So I'm going to have to do the same thing. I'm going to have to credit retained earnings. So my journal entry to make revenue zero is going to be a debit to revenue and a credit to retained earnings. And when I do that, how much will be left in my revenue account?
0.
Zero. And my retained earnings account will have increased because what does revenue do to retained earnings?
Increase it.
It increases it. Yep. All right, are we good here?
Yes.
The following information is available for Higgins Travel. After closing entries are posted, what will be the balance in the retained earnings account? So, beginning retained earnings plus net income minus dividends equals ending retained earnings. So my beginning retained earnings is 300,000. My net income is 60,000. My dividends are 20,000. So my ending retained earnings is 340,000. Good there?
Yes.
Yes.
A physical count of supplies on hand at the end of May for Masters Inc. indicated 1,500 of supplies on hand. So I have $1,500 of supplies on hand. The general ledger balance before any adjustment is $2,000. So this is weird because what I have is my balance is $2,000 in the general ledger. What is the adjusting entry for office supplies that should be recorded on May 31st? So, oh, I know what I did. I did it backwards. The general ledger balance before any adjustments is $2,000. At the end of May, I counted the supplies and I have 1,500. How did I get from 2,000 to 1,500?
You use supply.
I used supplies. I used $500 worth of supplies. So this is going to be my supplies expense. So my adjusting entry is going to be supplies expense and to reduce my supplies account by $500. Are we good there?
Yes.
Yes.
We want to know the unearned rent account balance at the end of December after the adjustment. So on October 1st, so we have 10/1 through 12/31 is how long, how many months?
3 months.
3 months, yep. Goodwill Company rented a warehouse space to a tenant, so that's rental revenue, for $3,000 per month and received $15,000 for 5 months. So on 10/1, we received cash of $15,000 and recorded unearned rent revenue of $15,000. So on 10/1, in my unearned rent revenue account, we have $15,000. Rented the warehouse space to a tenant for $3,000 per month. We want to know what is the balance in my unearned rent revenue account at the end of the year. So we have $3,000 a month for how many months?
3 months.
3 months. So we have $9,000. We've used $9,000 or we've earned $9,000 of the rent because they've used the space for 3 months. We want to know what is the balance at the end of the year. So we started with 15, 9 was used up. So we have a $6,000 balance, which is what they asked for in this question. Are you good there?
Yes.
Now we want to know Sandboard company rents space to a tenant for $4,000 per month. We want the adjusting entry. Rents space to a tenant for $4,000 per month. The tenant currently owes rent for November and December. Owes for November and December, so owes 2 months. The tenant has agreed to pay the November, December, and January rent in full on January 15th and has agreed not to fall behind again. Okay, as of December 31st, did they pay us?
No.
No.
No, they don't pay us till January 15th. So for December 31st, we just have to record revenue for November and December. So we're going to record rent revenue for $8,000, 2 months. And what's our other account going to be? Rent what?
Expense?
No. Hold on. Okay, let's go back to what happened. We rented a space to somebody. They're paying us. So we've earned revenue, but we haven't received it yet. So if somebody owes us something and they're going to pay us later, they're paying us, what
Okay.
type of account is that? How about a receivable? Just like accounts receivable, except for in this case, it's rent receivable because they're going to pay us later. Does that make sense?
Yeah, because payable is a liability.
Right. If it was, if we owed rent, then it would be a payable. But we are the person that's renting the space to somebody else for money. So for us, it's rent revenue and a rent receivable.
So the answer is for a journal entry then?
Yeah, all they want is the adjusting entry on December 31st.
Okay.
So it doesn't matter what's happening in January. Okay, for this one, you have like a trial balance. You have a lot of different accounts and you have to know what is net income for the current period. So you have to be able to identify revenue and expense accounts. Now, let me tell you just a couple of things, or one thing, well, 2 things that trip people up. Capital is not revenue, and dividends are not expenses. Even though you're spending cash, they're not expenses. So you need to be able to make sure that you're only identifying the revenue and the expense accounts. And then obviously net income is revenue minus expenses equals net income. Are we good there?
Yes.
Okay, we want to know how to close the dividends account. So for the year ended December 31st, a company had revenues of $400,000 and expenses of $200,000 and paid dividends of $60,000 during the year. The balance in the retained earnings account before closing is $100,000. So we're sitting here with retained earnings of $100,000. And we had dividends. Just dividends usually have a debit or a credit balance. Do I increase dividends with the debit or with the credit?
Credit?
They're like an expense. They're not an expense.
They're not an expense, but they're like an expense. So
Well, because it's an outflow, because they reduce equity.
understood. So it would be credit.
No, look at your resource sheet. If
I'm
I,
sorry.
a debit, yep. So I have dividends of $60,000. Now I want to close the dividends account. I want to make dividends 0, and I want it all to go into retained earnings.
So would you credit dividend 60,000
Yes, you would.
and you increase return earnings by 60,000?
Mm-hmm. Yep. So the journal entry is going to be retained earnings and dividends for $60,000. Good there?
Yes.
22, source of cash under cash flows from investing activities. A machine with a cost of $200,000 and accumulated depreciation of $100,000 is sold for $60,000 cash. All that we record on the cash flow statement is cash. So how much is going to be recorded on the cash flow statement?
60,000?
Yep, that's it.
1,000?
Yep, because all the rest has nothing to do with cash. It has to be cash. Here it's a cash inflow. You have to know that on the cash flow statement, only cash goes there. If I buy $1 million building and I pay $100,000 down, the only thing that's going to go on the face of the cash flow statement is the $100,000 down. I don't know what we're asking here. The accountant for Huckleberry Company is preparing the company statement of cash flows for the fiscal year just ended. The following information was available. I don't know what the question is. Cash dividends, I don't know what the question is. Oh, use the information to calculate cash received from dividends. This is another one I'll probably curve for. Okay, so the way you figure out here, I'm just going to show you. We know that we want to know cash, right? We know that we have 40,000 in revenue from dividends. But we want to adjust it for how much cash was received. So if the receivable on January 1st was $5,000, and the receivable on December 31st is $8,000, that means that 3,000 of this 40 went into a receivable and we didn't receive it in cash. So what you're going to do is you're going to add the $5,000 beginning balance in the receivable and subtract the ending balance. And you actually received cash of 37,000. Because I know that if my receivable increased, that means that there was revenue that I recognized that I didn't receive cash for. If my receivable increased, there's revenue that I recognized, in this case, dividend revenue that I recognized that I did not receive cash for. That's a slightly complicated concept. Are we okay so far?
Can you go over it again?
Yep. Okay, so let's say that we think about it from, if we perform a service and we don't get paid, we record what we didn't get paid as a receivable, right?
Yeah.
So I'm trying to figure out, I have dividend revenue of $40,000, and I'm trying to figure out from my cash flow statement how much of that I actually received in cash. And the way I'm going to do that is I'm going to say, okay, on the first of the month or the first of the year, I had a $5,000 receivable in dividends. They owed me $5,000. At the end of the year, I was owed $8,000. So during the year, I've become owed $3,000 more than before. Does that piece make sense?
Yes.
Yes.
But if I had revenue of $40,000 and I'm owed $3,000 more now than I was before, that means that $3,000 of that revenue I must not have collected as cash because they owe
Okay.
it to me. So
Oh,
the cash that I received is $37,000.
Oh, okay. That makes sense.
After posting the entries to close all of the revenue and expense accounts, the income summary account of Cleaver Auto Services has a $5,000 debit balance. So here is income summary. Has a $5,000 debit balance. So remember that with income summary, revenue is a debit and expenses are a credit. So if I have a debit balance, that means that revenue exceeded expenses. So a debit is going to mean that they have net income. A credit is going to mean that they had a net loss. So in this case, the answer would be true. Make sense?
yes.
We're done. Okay, how do you feel?
Overwhelmed.
Yes,
Okay, that'd
very
be
much.
normal. That would be normal. That's normal. My daughter has a birthday party Sunday afternoon for a few hours, like afternoon my time. So if it's 3 o'clock my time, it's 1 o'clock in it's 12 o'clock in California. You can text me during her birthday party. I won't have my computer there for a few hours, but other than that time, you can reach me most of the weekend if you're working and you have questions or something you don't understand.
Okay.
Also, if you look at the course announcements, I'll post this video, but also if you look at the course announcements, there's a blank one of these PowerPoints, so you can actually take it and work it yourself to make sure that you understand it.
Was this a review of the test for this week?
Yep, yep, for the one that you take this weekend.
Okay.
Okay,
Yes.
all right, so study, call me if you have questions, text me. Other than that, I will see you on Tuesday.
Sounds good. Thank you.
All right, thank you
Thank
guys
you.
for coming. I'll see you on Tuesday night.
Have a
Night.
good night.